Straight-line depreciation.
Straight-line depreciation is the simplest method of depreciation. We start with the purchase price of the asset. From this we subtract the scrap value and divide the remaining value by the number of years of useful life. In Figure 4.9 it can be seen that the depreciation taken each year is the same, $4,500. Each year the accumulated depreciation increases by $4,500, and the book value of the equipment is reduced by the same $4,500. The $4,500 of depreciation is taken each year until the scrap value is reached. From this point on, if the asset is still owned by the company, depreciation expense is no longer taken. If the asset were sold before the end of its useful life, the difference between the selling price and the remaining depreciation would be taken as depreciation expense in that year. Suppose the asset were sold at the end of year 4 for $20,000. At the end of year 4, the remaining book value is $21,000. We would take the $1,000 of depreciation expense and clear the asset from our books. If the same asset were sold for $25,000, we would show a profit of $4,000. A depreciation expense of $21,000 would be taken, $25,000 would be added to the cash account, and $4,000 would be added to the equity account as profit on the machine. Accelerated depreciation is used because it effectively reduces taxes on the company. Although the total amount of depreciation expense taken is the same as it is in straight-line depreciation, with the accelerated depreciation method, the depreciation taken in the earlier years is significantly greater than it is in the later years. Since larger amounts of depreciation mean that the depreciation expense is larger, the net profit before taxes is going to be smaller. The taxes are figured on the net profit before taxes, so the taxes will be lower as well. Now the total amount of tax the company pays over the years is going to be the same regardless of the depreciation method, but some of the taxes will be deferred to. Figure 4.9, Straight-line depreciation. Later time. Since the money we pay someone, the IRS in this example, later in time has less value, we will profit from accelerated depreciation. This may all seem a bit strange, but it is a win-win situation all around. Companies like to accelerate their depreciation because it reduces their taxes in the early years of the equipment's life. The government likes this too because it encourages the company to sell the equipment before the end of its useful life and buy a new piece of equipment. The new piece of equipment not only makes the company more profitable and pays the government more taxes, it also makes profit for the equipment manufacturer, who in turn pays taxes on that money to the government as well.